And welcome to ETF Edge, your go-to place for everything ETS. I'm your host, Bob Pisani, of course, and we count down into 2021. We're going to be looking at big trends in ETFs and investing for the following year. Today, at a special edition of ETF Edge, we look at one trend that's gaining adherence, and that's multi-factor investing. Our guest today, as always, three of the best in the business. Andrew McCormick, he's the managing director of Wallach-Beth. Steve Sachs is the head of capital markets for ETFs at Goldman Sachs, and Steve DeRoyan is U.S. head of asset allocation and ETF product at John Hancock Investment Management. Gentlemen, thank you for joining us. First, what exactly is multi-factor investing? It's investing that shifts away from plain vanilla investing, like just buying an index fund, for example, like the S&P 500, and toward other investment metrics, like size, for example, like small caps, or towards momentum, or towards value. But it can also include fundamental factors like sales or cash flow or dividends, even buybacks. It combines them to seek maximum return, hence the word multi-factor. Now, Princeton professor Burton Malkiel was on ETF Edge a couple weeks ago. He is the author of the legendary investing book, A Random Walk Down Wall Street, and he's famous for his pronouncements that the average investor cannot beat the markets. He did speak favorably, however, about the possibility of multi-factor as a risk-adjusted investment strategy.
If you're going to be a factor investor, I believe in a multi-factor approach. And the reason is that the factors tend to be negatively correlated. That is to say, when value fails, momentum tends to do well. And so I agree entirely with Dave that this is possible to have a multi-factor portfolio that tends to reduce risk and gives you a little higher Sharpe ratio. The Sharpe ratio is return relative to the risk you are taking. So I agree with Dave that that is possible. Now, you want to do this, however, at low expense. If you've got a multi-factor portfolio and you're charging 100 basis points, I say avoid that like the plague. But if you can get an ETF that's 10 basis points or less that does this, it's a reasonable way to invest. And there is some evidence that firms like Dimensional Fund Advisors, who have used a multi-factor approach for quite some time, have in fact been able to get a little better risk-return trade-off.
Steve Sachs, I wonder if you could pick up on what Professor Malkiel was saying. What are the advantages of considering multi-factor investing over plain vanilla investing or even over single-factor investing?
Yeah, well, look, Bob, he really did a nice job of explaining it there in a very short period of time. That really is it. So when you think about what we're doing at Goldman Sachs Asset Management with the Goldman Sachs, active beta suite of ETFs, GSLC is our U.S. large cap fund. So first and foremost, Burton said it well, cost is always important. We priced GSLC at 9 basis points, so actually cheaper than even market beta for exactly that reason. One, we just wanted to take it out of the equation, take it off the table from a discussion perspective, and focus on the actual strategy. And when you think about what you're doing in a multi-factor strategy, as we've talked about, picking factors is difficult. Timing factors is even more difficult. The non-correlating aspect of the factors, particularly the ones that we use in GSLC, are extremely important to the construction. So when you think about what those 4 factors are, value, quality, momentum, low vol, one, time-tested factors that we've been investing in at GSAM for multiple decades, time-tested both from a practitioner perspective as well as academically. But then to Burton's point, those are very non-correlating or negative correlating in many cases across those factors. Look no further than this year and really the last couple of years. Value in particular has been a very difficult factor from an investment perspective. But the offset to that in a multi-factor approach like GSLC is that what has really worked well? Quality, momentum, and then obviously low vol from the perspective that, right, all returns are path dependent. So dampening the volatility within that portfolio goes a long way in, again, producing just a better risk adjusted return. So it's really not only the factors in which you choose, how those factors correlate to each other, and then how you combine them in the portfolio.
Yeah, Steve DeRoy, I wonder if you could pick up on what Steve Sachs was just saying there. Is there evidence? So we talk about the standard factors. We talk about quality, we talk about momentum, we talk about value, we talk about size. Is there evidence? Is there academic evidence? Is there trading evidence? What evidence is there that multi-factor actually kind of outperforms? Because Professor Malkiel, who is, of course, very curmudgeonly on the issue of anything outperforming the market long term, seems to have a bit of an affinity for it. Is there actually evidence that this does better, multi-factor?
Well, excuse me. Thanks, Bob, for having me on, and I appreciate it. Great to share the stage here with Steve and Andrew as well. I think that the evidence is fairly clear historically, right? And look, if we knew what the market was going to do tomorrow, we'd all be on the beach, right? So we don't know what tomorrow is going to bring, but the historical evidence would say that factors do exist, they do persist. I think the most difficult part of understanding factors in general is really what Steve alluded to is timing is really tough. And so the way that we at John Hancock believe to invest in factors is to have that consistent exposure. That consistent exposure should be in the factors that you think are going to give you the best chance to outperform and be on a smoother ride. And so in our model, we have it's a little bit simpler than what our friends at Goldman have put together. We focus on size, which has historically shown an outperformance. So we'll look at smaller company stocks, and we focus on value. So we look at companies that are relatively less expensive, and then we look at profitability, which is really similar to a quality factor. So those three factors go into our recipe, and I think what you'll hear from Steve and myself is that the recipe is important. These factors do play well off of one another. The historical evidence is there. Of course, there's no guarantee for the future, but the history is there from an academic perspective that these factors can come into play. And then if you believe that you can time them, good luck to you. We find that the consistent exposure is going to result in a longer-term, smoother ride and going to result, hopefully, in better performance.
What I find interesting, and anybody can jump in on they want, is that this sort of fits with Malkiel's thesis. Malkiel basically says, look, forget about timing the market in general. Number one, that's a Burt Malkiel mainstay. The second is you generally can't beat the market, but there is academic evidence. Nobody picked these factors out of the air and decided to like them. Nobody picked value, momentum, maybe growth, size, out of the air and decided that they liked them. There is some historical academic evidence that at various times these factors do outperform. The problem is getting the market timing right seems to be difficult, if not impossible. And so when you see outperformance with these certain kinds of factors at different periods, although we know when it's going to happen, when you combine them, it would make some sense to try to get some alpha. Am I describing this right, Steve?
Right.
Either
Bob,
Steve or Andrew?
I'll jump in on that if I can. I think the timing is, it's a variable question. So if we're talking about, while at BEP obviously have a great view on what institutions are actually doing, what they're actually trading, and how they're moving around. So it's like I said earlier on the live show, sometimes it's time to, pay the professional. And in this case with Goldman Sachs, we're talking about 9 bips, right? 17 and 18, you have a year where every major indice is within 5 bips of each other, right? And when you have a year like that, you can't argue that you're sitting in the lowest cost investment, and that's possible. But then along comes market, uneconomic related catalysts like COVID, and that causes the opportunity to get a chance to have outperformance, and I think you have to take it. So it's not a short-term, timing, but it is still, these institutions have mandates. They have certain returns that they have to have. You can sometimes only get that by taking the shots when you get them. So, for example, in the value tilt that John Hancock has, now might be the perfect time for that, because history would show that that's going to mean revert. If you've sat in that trade for a few years, maybe you've slightly underperformed, certainly in the last 9 months, but that will be a short-term trade, and you can close that gap and still be very close to beta by simply transferring some assets to the professionals like John Hancock's value tilt or towards the GSLC, and you will have a shot at outperforming SPY or certainly any of these Vanguard names. And I think it's worth that risk.
Yeah.
Yeah, and look, Andy, I think Andy's point is a
John
really
DeRoy,
good one.
maybe you can explain to. Go ahead.
Oh, sorry, Bob. I was just going to say, I think Andy's point is a really
Go
good
ahead.
one relative to institutional, asset allocation. And again, it's a great example for, not only what we're doing with GSLC at Goldman, but certainly what the folks at Hancock are doing. Look, these are, again, all time-tested factors. And the fact of the matter is that institutions have been investing in these factors for many, many decades in various forms. Now, again, from a market timing perspective or a factor timing perspective, they have a much finer point on their process and their portfolio construction to be able to use those tools and lever them up and lever them down at the right time. From a broad investor perspective, we felt providing more of an all-terrain vehicle where, again, you're getting exposure to, multiple factors at the same time in an equal risk-weighted basis really has benefits for, a broader portfolio set. Something like GSLC can certainly be used as a core in a portfolio. And then to the extent that you want to tilt to a particular factor, you certainly can. Same thing like with the multi-factor approach that John Hancock is doing. And, their work is well respected by us and everybody else from the exact same reason.
Yeah. John DeRoy, and I wonder if you can sort of pick up on that. Sometimes this is difficult to explain to people what multi-factor is, but the point is there is historical evidence that certain factors do outperform during certain different times. It's very difficult to figure out the market timing, but size, value, profitability, I know you tilt towards that. There's evidence that has outperformed in the past. You combine it in a multi-factor. I'll tell you what I find remarkable. Both you and Goldman have a large cap multi-factor funds. Goldman has GSLC. You have JHML, which is the John Hancock multi-factor large cap. And still the largest holdings are mega cap names. So you have Apple, Microsoft, Amazon, Alphabet, Facebook, all of the among the largest holdings. It's kind of remarkable that those are the ones that outperform so well. I know momentum isn't necessarily a major part of this, but can you explain how you...
Yeah.
What's the philosophy behind the construction?
Yeah, absolutely. Well, so a couple things, and Steve Sachs mentioned, the equal weight construction that they use. This Steve will mention from John Hancock a more of an integrated approach. So our approach is a little bit different in terms of how we put the ingredients together. Not only are the ingredients a little bit different in terms of the factors that we each focus on, but then how we put them together. The approach that we use is more integrated. And part of that integration goes to sort of one fundamental fact, which, Dr. Merkel would say the same thing, which is you got to believe in the market, right? So when you think of factors, there isn't a stronger factor historical outperformance than the market versus cash, right? So if you're not exposed to the market in some way, shape, or form, you're going to underperform, right? And so what we look at in our construction is sort of starting at a market cap level and then tilting the portfolio. So to your point, you end up with some of the mega caps as still being big parts of our portfolio. We don't want to put so much octane into this product that you no longer have a large cap product. We want a large cap product. If you have a large cap product that doesn't have a strong weight to companies like Apple and Microsoft, I mean, Lord knows what would have happened to you over the last couple of years, right? Especially the last 9 months. So when we think of the construction, we think about the market first, and then we tilt slightly to take advantage of these factors over time. And, the historical evidence, as you mentioned, does prove out that, value has historically done well from the 20s on to the almost 100 years now that you can go back and look. That said, the last, 5, 6, 7 years has not been fabulous. The great thing about multi-factor is when you add in the sort of the yin to the yang and you add in profitability, all of a sudden you now have a ballast that makes this portfolio perform in a more smooth capacity than you would hope if you ratcheted up that value factor to the nth degree, which is what a single factor product should do. You're going to be significantly underperforming, which is okay if you want to time the factor. There's a different ingredient for everybody. If you're a person who believes in value investing and you want it, you don't want to buy our product because we're not going to give you enough of that spice. You really want to go after that value. Go get yourself a single factor and take on the risk that's associated with it. You want something to fit in your core, products like Steve's firm offers and products like ours offer are going to fit a little bit better into that package and probably give you a little bit, nicer sleep at night.
Well, that's the whole point of multi-factor, right? I mean, single factor, it doesn't work that well, right? I mean, look, we all love Warren Buffett, but the value has not worked for a decade, not 5 years. It hasn't worked for a decade. I mean, someday it will, and maybe now is the time. But this a decade's a long time to wait, even for Warren Buffett.
Right, and I think that's the point. Bob, is that I would say it doesn't not work. It just hasn't worked lately, right? And lately is a 10-year time frame, so it's been a long time. But the point of the factor is over that 10-year stretch, there has been times where it has worked. And if you want to take advantage of that single factor, that's the beauty of our marketplace, right? It's free and open for that reason. If you want it, you can get it. Trust me, somebody's doing it for you, right? Yeah. So I think that's the value, no pun intended, of what we offer as a free market enterprise.
Right.
Yeah,
hey Andrew, you're sort of more involved in the trading end of things. Let me just ask you, Andrew, how is multi-factor being greeted by the ETF community, the trading community in general? Do they understand the theoretical underpinnings behind it, that there's academic evidence? I mean, is there evidence? Plain vanilla, frankly, seems to be winning. I mean, I don't know if people are not sophisticated enough to understand factor and multi-factor, but the big flows are in plain vanilla these days. Is multi-factor? Do you see any evidence that multi-factor is catching on in a big way as a trading?
We actually do, and we're going to see it increasing. And I'm going to give you two reasons, two specific client sets, why we're going to see more flows into this product. So, they mentioned DFS earlier, right? So DFS, I mean, that is like, win or lose, they're going to tout themselves as the smartest of the smartest, right? And they have, I've been to their office in Austin. There is hundreds of brain think tanks in there figuring out and coring through balance sheets and things like that. However, even with their funds, you couldn't even get access to that unless you were under certain tiers, right? In the last decade or before they had launched their own product. But the point is, coming up to this, you have two specific audiences that are very prevalent in ETFs as the products have grown. That is RIAs, and that is individual investors. So we'll start with the RIAs. RIAs, $500 million, $2 billion, who are really good at raising money, really good at looking at their individual clients and saying, you need this and you need that. ETFs are their tool, or I should really say Goldman and John Hancock are their tool, their way to access the brains at these shops for 9 bips, right? And they're going to get this chance to outperform. Again, think about it just from a holistic point of view. The RIA wants to keep his client as a client, not say, okay, you go off and do it on your own. So he needs to provide value to this client. I believe we're entering a market where it is clearly worth they're highly correlated. So the downside, like your speaker said a few weeks ago, the downside is clearly not as bad as missing the upside that a factor ETF could give you. And of course, with so many products out there, you can choose. As it relates to the individual investor, I do believe that we're in the best stock-picking market that we've had in a decade, right? Look at something like Penn Gaming versus the other casino stocks. But that's a very hard game. And I think what will happen is these Robinhood investors get through the year and they go, wow, I was up 45%, and they start talking about that. They will smartly be advised to take a little bit off the table. They can still pick what they like and then ultimately choose a factor ETF to represent their view as they take a little of these single stock profits off the table and mitigate risk. I think it's actually a perfect storm for these products.
Yeah. Hey, Steve Sachs, I got to wind this down a little bit, but one of the things I notice about these kinds of funds is that there's not a remarkable deviation from the S&P 500. I mean, if you lay over the GSLC over the S&P, it's not that dramatically different. Maybe this is a testament to your stock picking skills, because it's tough to beat the market, as our friend Mr. Malkiel likes to say. But I don't notice dramatic outperformance, even if you go past several years. What does that tell us? Is there a period where you will outperform or you'll underperform, or is it not fair to compare it to an S&P as a benchmark?
Well, hopefully, Bob, we leave a few minutes to talk about your Black Sabbath concert poster in the back. But look, that's the whole point of GSLC, is that low tracking error. And, when you talk about stock picking, again, remember, GSLC is a passive fund. It's based on an index. And the whole idea is taking the index, taking what we might do in our actively managed business, quantify it, make it rules-based, and make it repeatable. And I'm going to say that last part again, make it repeatable. Rightly or wrongly, you know exactly what this fund is going to do because it's going to follow the strategy and it's going to rebalance on a quarterly basis. And then ultimately going back to everything that we've talked about, you know, through this whole segment, it really is about the tracking error for GSLC. It is designed to have a very low tracking error to the S&P 500 or to the U.S. large cap, index as a whole, and that's by design. Long-term calibration on the index is about 2% tracking error. Since inception, a little over 5 years ago, it's actually been tracking about 1.5% on a tracking error basis. Again, by design, the whole idea is to have something that you can use as core or ballast in your portfolio, and then tilt either with single factor ETFs or one of the biggest implementations that we see in the advisor community that Andy was talking about with GSLC is actually pairing it with an active manager, a true fundamental bottoms-up stock picker that has a very concentrated, high active share portfolio, pairing it with something like GSLC that's going to give you very benchmark-aware returns, as we like to call it, or essentially, the market.
Yeah, I think,
okay, guys,
Bob,
I appreciate that. It's been a fascinating discussion. Quick, Andrew, go ahead.
It's actually the other Steve.
I
was just going to say, you mentioned
Steve, Steve, go ahead.
That's okay, no worries. There's been a little bit of underperformance relative to the broader benchmarks, and I think you really hit the nail on the head when you mentioned value underperforming for the last 10 years, right? And so that factor is really in most people's, is an ingredient in most people's multi-factor because it's been such a strong performer relative to growth over the long haul, right? And so, when you think of, you mentioned, our friend from Nebraska, and so, I think at the end of the day, as Andrew alluded to, maybe this is the right time to say, hey, we've got an opportunity to take a look at what's inside of these products, and if we think that these tilts that these factors are going to give us make sense, maybe this is the right time to give a little love to these types of products.
Okay. All right, guys, I got to leave it there. I appreciate that. It's been a fascinating discussion. And Steve Sachs, the Black Sabbath was from 1976 when Ozzy Osbourne was still with them. It's the Velvet Underground is the rare one. That's the 1992 Germany show that they had there. And that's it for the history lesson and this week's ETF Edge. My thanks to Steve and to Andrew and to Steve. Don't forget, you can see all of our videos, etfedge.cnbc.com. Don't forget our podcast where we go into a little more depth on this. We'll be having some special shows in the next few weeks. ESG investing, retirement, high yield, all looking at what's going on in 2021. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.